I'm Teneale.
And I'm Kelsey, and we're financial advisors from 𝐴𝑙MAN Partners 𝗡𝑊𝑒𝑎LTH, bringing you thought-provoking conversations around you, your money and your life on the Wealth Experience podcast. Hello listeners, thanks for tuning in. And as you've probably guessed it from the title of the podcast, Teneale and I are going to be delving into the world of AI and how it's actually impacting people and how they receive information with relation to financial advice, of course, that being our specialty. So we're going to give you some understanding on the good and the perhaps not so good, so that you can hopefully be savvy enough to avoid any wealth destroying decisions. And the reason that this came about really was that one of our team members, Jodie, shout out to Jodie, plugged some information into AI and asked it to make a financial plan. And she shared it with us, and we thought, what a really great opportunity to unpack this for our listeners. And Teneale, I know you're really excited about doing this one today.
I am. We've been talking a little bit about AI and its uses, obviously across the world and in our business and all of those kinds of things. So it feels like it's a very hot topic right now, and lots of people are talking about it, and it's important, I feel, for us as financial advisors to stay on top of what's out there and what people might be using to try and seek as an alternative to coming in and getting human financial advice, I suppose. And the reason it's so important to look deeper and educate the broader community about this is because it really has a potential to impact and do some real good in certain circumstances, particularly for creating more affordable options for advice. But there's also some real dangers which can cause financial upheaval for investors and for individuals. Certainly there's a lot more information that's readily available, but it's just that at times, it's just information. And so what I thought we'd do today is have a look at it and understand what advice, and I'll put that in air quotes, AI actually delivered using Jodie's example, and so that we could sort of dissect that.
And it's just such an important topic. The financial advice industry in Australia in particular has suffered from a lack of trust with the general public following the Hayne Royal Commission 100%. A few years back. So there's certainly a question mark then with the trust around AI giving out advice. How do you apply that trust factor to it? So I think we do owe it to the wider public not to shy away from the topic and bring it to the forefront of the discussions, like you were saying, Teneale.
Definitely.
How we might be able to integrate that into the future so it's doing good all round.
I think so.
So with no further ado, let's share with you first then what was actually put into the AI bot. So, and when I'm saying AI bot, Teneale, I'm not too sure what it was. Was it 𝗣𝗹𝘆𝗲 or ChatGPT? Can you remember?
I think it was ChatGPT. That's a really good question. I think it was ChatGPT, but yeah, I might have to go back and have a look at that.
That's okay. Maybe we'll clarify, but there's lots of different ways that you can do this now. You can do it through lots of different forms of AI. So again,
that's right.
Which one do you use?
Into
How
Microsoft?
Do you know which
yeah,
one
all
is
of those.
Be the best one.
Yeah.
But whatever was used, the scenario was this. So Jodie put in, I'm a 38-year-old male in Australia. I'm married to my wife, who is 40. I earn $120,000 a year, and my wife earns $80,000 a year, and we have 2 children. I currently have $200,000 in my superannuation. My wife has $80,000 in her superannuation, and we'd like to retire at age 65 with a combined income of $80,000. Can you make me a financial plan?
Yeah, and I think this was a really good broad base, right? Because that could represent quite a lot of different people's individual situation, and is pretty a pretty stock standard one that you would expect in terms of a couple that's wanting to receive advice and sort of has that one goal. But
so to know somebody looking at that and inputting that data and hearing that for the first time might actually think, that's quite a lot of information. I've told you, where I live, how much I earn, the size of our family, when I want to retire, how much I want to retire on. That might be deemed as a good amount of information.
Well, I think that when you're trying to, input as much as you possibly can, you kind of go, yeah, this is. I'm thinking about my retirement goal. Here's a lot of information about me, but I guess for us as financial advisors, if somebody walked in the front door and they gave me that as the paragraph as to them as a person when we're seeking financial advice, it would seem, quite simplistic in terms of data inputs. So
that's a starting point.
That's a good starting point. Exactly. Yeah. Yes. And that is one thing that I would say throughout these conversations is that it's kind of an area that needs to be built on, right? To get a really good financial plan, you'd have to build on it wherever you're seeking that from. But what we can tell you, firstly, there's a couple of things that really jumped out in terms of that level of simplicity. Is firstly, there's one goal here that's been outlined, and that's the retirement goal. So we've told AI, hey, I want to retire at age 65, but typically, I mean, these are young clients, and there's almost always other goals along the way that are going to change the levers in terms of what needs to be pulled to get you to all of your goals, if possible, which would be the best case nirvana, wouldn't it? And I guess the if possible is important too, right, Kels?
Mm-hmm. Yeah, absolutely. And you know, that's what the big part of financial advice is like you were saying, the levers.
Yeah.
What if you could do it at age 60?
Yeah.
Would that change things?
100%.
Would you want to perhaps still do it at 65 but spend more?
Yes. And then say somebody, maybe you've seen them for advice. One of the questions might be, as you've pulled out those goals, well, you've got 2 children, you know, are they going to need to go to university? And if so, if you had to trade off sending the kids through university and therefore having to retire 5 years later, or they have to go and get help debt for university, but I can retire at age 65. You know, that's those priorities and being able to really articulate well what the goals are and prioritize what comes first.
Well, most people have more than one goal. Most people have more than one goal than just simply retirement, right?
Yes.
Especially
I would
late
hope
30s,
so.
early 40s.
Yeah, I would hope so for that demographic for sure. Yeah. And even into retirement. So retirement's one goal again, but there's going to be lots of things that you want to do in retirement.
That's right.
So back to the input. Secondly, the level of income that was required in retirement. So we're talking about $80,000 a year. How do we know if that's a sufficient retirement income? And the biggest reason that this could be incorrect is when we're considering for things like inflation. So if you're spending $80,000 now, what's that number going to be after inflating that year on year up until retirement and then throughout too, because that's not a flat number. And that, you know, these figures could include different things as well. So sometimes people will accidentally include expenses they will no longer have in retirement, or maybe they haven't looked closely enough at their spending and the number might actually be bigger than what it currently is. So if they kind of are looking at this scenario going, I spend $80,000 now, is it actually going to be $80,000 at retirement that I need? Because that can make a huge adjustment in terms of the lifestyle you want to live and also what capital you're going to have available to support that and what that needs to actually be. What does that figure need to be then? And
really what we're saying is that in, you know, these things that we're noticing straight away before we've even looked at what the answers are, this is just inputs.
Yes.
We're kind of going, well, is the AI bot going to be vetting this information?
Yes.
Is it being double checked? Is it being well thought through? Or is it going to take it on face value and assume that all that information is correct?
Yes, yeah. And that's the unbiased nature, I suppose, of the beast, is that if you had a human sitting on the opposite side of the table, they're kind of going, I'm going to play devil's advocate and going to press you for more detail, which you may not otherwise have thought to add in if you're just sitting behind the computer yourself.
That's right. So, okay, well, Teneale, let's get into the juicy part then and go through what the recommendations did come back as.
Yes. Great.
So we'll go through them one by one and try and unpack as much as we possibly can. So the first one that came through, then the first recommendation said, estimate the retirement savings needed as the heading that kind of came through. And then underneath that, it said to maintain an annual income of $80,000, you'll need to consider factors like life expectancy, inflation, which we'd just mentioned, and investment returns. A common rule of thumb is to have 20 to 25 times your desired annual income saved up. This means that you might need around $1.6 million to $2 million in total in retirement savings.
Okay. So they're going to have 20 to 25 years of income. Kaput, that's it.
And then what?
Yeah.
Okay. And it kind of doesn't say in there, you know, well, how much inflation based on what investment returns? Are you saying cash?
Well,
is this what we're saying?
I guess it would have to be if it just it said 20 to 25 times. That's, you know, I take my number and I multiply it by the number of years that I need and assume I don't really earn anything, and that's how much capital I need.
That's right. So let's try and see, I guess, the good. Let's see the good in this at the first. And the first thing is that it's given you a flag. It is flagging to you that you need to consider inflation and your returns and how long you're going to live. So
yes.
perhaps in that it's saying, I'm not going to give you all the answers, but here's some things to
go and
think about.
Research. Yeah.
But then kind of beyond that, it's not really helpful in terms of, well, what do I actually apply? What's relevant to me and what do I need? So it's given you a generic amount there in terms of the 1.6 to the $2 million, but it's not necessarily based on you, what you need. And this is where an advisor really adds the value in terms of modelling the situation out, but maybe an AI bot could be trained to do that eventually. Or, if it was more complex and continued to ask more probing questions, it could model it out for you.
And that's interesting, because I have actually thrown a scenario into AI before, just on simple returns, just a simple returns factor and understanding, what does that need to be. But you're right, there's some potential to do some of that modelling. I guess, your question is, how do you know where to start as the consumer of that data as well too?
Absolutely. I mean, if you kind of knew what you needed to do and what all the inputs were and all the factors to consider, you'd be an advisor, right?
If you want to be an advisor, come and speak to Kelsey and Teneale.
So look, I think 20 to 25 times annual income, that's a really good place to start. But again, beyond that, it's not really specific to you. And is it 20 times or is it 25 times?
Yeah.
Because that can be a big difference.
Is it 1.6 to $2 million today's value or future value?
Absolutely. So, that might not even be sufficient to cover your living expenses. And like we were saying earlier, it actually hasn't considered any other factors or any additional money that you might need in the interim.
Yeah. Or it might be too much. It might be too much. It might be saying, well, you need that flat rate in assets, but what if we could get a compounded return of 6%? I don't need that much capital. Yeah. Yep.
And other things to consider that, again, is the conversational part, right? Let's say you've retired and you said that that's your only goal. What if in the back of your mind you're like, oh, well, I'm probably going to need a new car at some point during retirement, or I want to leave money to the grandchildren. How do I facilitate that? Or whatever that looks like. It's not really giving you that piece at all. So broader thinking is needed in that respect. So to me, when we're looking at this answer, it's not really an answer as such. It does give you a really good foundational starting piece, but it doesn't give you, good financial advice to give you peace of mind around your future. It's not specific enough. So what you would hope to see here is, sitting down with an advisor, making sure, like we said, living expenses are correct, figuring out what's going to be an appropriate asset allocation for you that's going to deliver the returns that you want, need, and what you're comfortable with, because that in itself can be a trade-off, which I think we'll probably speak through at some point in the asset allocation investment section to Neil. But that's really going to then inform what the numbers are going to be and what you need.
Absolutely.
And again, another thing that hasn't really been explored there, have you got longevity in your family?
Yeah.
Because, if lots of your family members are living to 90 to 100 consistently, is that number projecting out far enough for you if you're going to expect to be living a lot longer than other people perhaps?
That's exactly right. And I think it did sort of mention in there, it did mention life expectancy. And so what is life expectancy? It's a set of tables that tells us, based on all the people that came before us and outdated data, so usually from 5 to 10 years ago, what was the average life expectancy of the cohort that was under study. And what do we know about life expectancy? It increases over time. So technological advances, medicinal advances in our way of living, that increases life expectancy. And so if we were looking at a 38-year-old man in this scenario, it might say 81 odd is life expectancy. But am I comfortable knowing that I retire at 65 and have less than 20 years? So I've accumulated 20 to 25 years of income, it's told me, but I'm assuming that I'm only going to live for less than 20 years in my retirement. These days, I would be thinking that number's quite low, and most people would not feel very comfortable with that.
Absolutely. So really, Teneale, in summary, okay-ish answer as a starting point, but not really an answer, and still lots of things to consider and unpack within.
We're getting question marks. Let's put it that way.
There's lots of question marks, that's right.
So there was a section then that did start to talk about those growth returns. So the next thing that the AI generated response came out with was saying to go and calculate your superannuation growth. It said, assuming an average annual return of 6% on your superannuation investments, you can use a retirement calculator to estimate your future super balance. And then it went on to provide a tool which you could do so. Okay. What are the good things here? First of all, what's good is that it's saying, hang on a second, you were right. There are going to be some returns that you're generating on your portfolio. What it's not delving into is how it came up with the assumed return that the portfolio was going to receive. So firstly, 6%. That looks like a lovely number. What a lovely round number. What is the 6% annual return based on? And is that 6% above inflation, or is that a total return of 6%? And by that I mean, if inflation runs at 2.5% to 3%, let's say 3%, do I need to achieve a total return of 9%, knowing that each and every year the cost of living is going to rise by 3%, or do I just need a flat 6% on the portfolio? So that was probably the first overlay I saw when we read into this in a little bit more detail.
It also, Teneale, doesn't disclose whether that's net of all fees and costs.
100%.
So is that a gross return?
Yeah, that's right. It didn't indicate that. It just said if we assumed 6%. So there's a lot of, again, questions as to what is that made up from? Where is it coming from? What is AI assuming that we're investing into? So you spoke a little bit earlier, Kelsey, about asset allocation here, and by that we mean, what allocation do you have to growth investments like shares and property, or defensive assets like fixed interest and cash? What's your allocation to each of those to be able to achieve a 6% return, let's call it? And even if you did know the overarching level of growth and defensive assets that the AI has assumed here, so maybe we're being overly generous and saying, okay, 70% growth assets and 30% defensive assets, how much due consideration is there to what are the underlying assets like Aussie shares, global shares, property, bonds, sub-asset classes, large value, small companies, emerging markets? You know, it trails on and on, doesn't it?
It does. And I think you have to question, why is that relevant? Why do we need to also unpack and understand that? And one of the big factors is because if your portfolio that you've got, or one that you're looking at and considering after looking at this, is going to give you the 6% return, assuming you know whether that's net or gross or whatever that is, are you going to get that in just holding fixed interest, or is your portfolio going to be 100% in growth assets, so which is there for a lot more volatility to achieve that? Because you want to have the easiest road, the easiest investment journey.
That's right. And
if you can get 6% in a portfolio that you don't have to have all of those growth assets, then is that going to be a better option, is probably what I'd say. Not that it's the best option, because there's other things to consider, right?
That's right, but you're putting your risks into the consideration then, aren't you? Which, and one thing I will say about humans too is that if I read this information and said, okay, AI's told me that I need to achieve 6% in my portfolio, the first thing that I might do is go back and have a look at my super returns for the last year or 2 years or 3 years, or however long data is that they're going to provide me there. And that's it. That through that lens, I might go, hang on, it's been really good, and my portfolio has generated 9% returns, and I'm really confident with that. So I don't need to do anything because my super's already generating 6%. And what a dangerous assumption to make then, right? Because maybe my portfolio has a heap of growth assets, like you're saying, and then for the next 5 years, or when I hit retirement, there's a massive global financial crisis or a massive downturn in markets, and I don't get 6%.
Which is expected and is normal over long periods of time.
It is. But if I haven't factored that in anywhere in this scenario and just assume that previous returns were indicative of future returns, I can really bind myself into a bit of a problem there. But Kelsey, I like what you were saying, though, when it comes to thinking about risks that we need to be considering and mapping out, because I know that previously our listeners would hear us talking about that risk triangle. So now thinking about what type of risks does the portfolio actually need to take on, we talk about it in the 3 different areas. So one being risk required, so how much return do I need, so therefore how much risk do I need to take on to reach my goal, in this case my retirement goal. Secondly, my personal risk tolerance. So how tolerant am I as an investor to volatility in the portfolio, to the movements up and down, and am I going to stay in my seat during negative periods of time? And then risk capacity being the third one. So what's the time frame that you have on your investment for it to work for you? And again, we come back to, in this scenario, AI said that this is based on life expectancy, so it's probably taken some risk capacity there and understood that there's 20 years odd that it needs for the money to work for. But again, what is that for each individual person? And then how those three risks overlay is going to tell us how the portfolio needs to be invested.
Absolutely, and I think even within that, there's so many more things to unpack, because someone might say, I'm a really risk adverse, conservative investor, I don't want to have all my money in the share market.
Yes.
We've heard that a few times.
Yeah, most people feel that they are conservative.
Right?
Yeah.
But then, you ask more questions, you get to know them, you understand their history, what they've done previously, you might even provide some investment education, and then all of a sudden you've come to the conclusion, well, actually, maybe you're not a really low tolerance investor, and you would be more comfortable with investing more money in the share market because risk and return are related. You're going to assume that you're going to get a higher return over the long term, and you're happy to do that. But if you hadn't unpacked it and had those conversations, the AI bot, for instance, might just assume that you're low risk tolerance.
That's right. And we've spoken a lot about like the emotion and investing. Those things are very counterintuitive to one another a lot of times, like uncorrelated, or negatively correlated, I should say. And that's a real important piece that we can't miss in all of this, Kels, is that, if I'm sitting behind the computer, I'm just saying, I might even tell AI, hey, I'm a conservative investor, and AI goes, that means that their return's going to be lower.
Yeah.
And it's a one-way street to the end return in this factor, which we know is not how good portfolio management works. But I mean, even if we assumed in this scenario that you did want your capital to last, I'm going to be a bit more generous and say maybe it's to age 95. So there's almost 30 years now before you retire, and then there's 30 years into retirement that you want your capital to still be working for you, and you're comfortable with the volatility in markets, and you need the growth to obtain your lofty future goals, right? So perhaps right now you are a high growth style of investor, and you can target for returns that are 6% above inflation or around 9%. However, what if you said that the last time you invest in shares like you're talking about, you panicked, COVID came about, you sold out of your shares, you put them to cash, perhaps you would have been more confident in knowing that if you took a portfolio with lower volatility, and that meant you might have to move your retirement goal by 2 or 3 years in a case where there's a lot less volatility, you could still get there and remain in your seat during that whole space of time. And those are the complex decisions that often require human discussion, like you're talking about there, Kels, aren't they?
Yeah, and there was something I was thinking about there when you were speaking as well, Teneale, in that, the opposite could be true too, in that you might have an investor that says, 6% return? I'm not going to be touching my money until, 20, 30 years from now.
Yeah.
If I can, take on more risk and get a higher return, and that means I can either retire earlier or spend more in retirement, sure, I absolutely want to do that. But you've just told me I need 6%. People sometimes will, the question that was input and the data that was input is based on what someone thinks they need. So if this individual said, 80,000, that's what I'm spending now. Well, hold on a minute. What if I actually want to spend $90,000 to $100,000 in retirement, and by taking on more risk, achieving a higher return, I can do those things?
Yeah.
But that's a conversation.
That's right. That's right. Or you flipped it, like you say, you flipped it on its head then, and I actually get to retirement and I've got $2.5 million. I'd probably like to know, could I have retired earlier?
That's right.
So now I can spend more, wonderful, but could I have retired earlier if I had have known this information, had a plan as I went? Yeah. Exactly. There was one great thing. Now, I did mention at the start that AI directed us to a retirement calculator tool, and that was one on the Money Smart website. And it's great because you can plug in lots of information, your age, your income, super contributions going in, and it will give you some really high-level outcome of your capital needs, so how much money you're actually going to have need for retirement. But one thing that we would say is it doesn't allow for additional considerations such as tax on super contribution, changes over the years to how much your super contributions are. We know that they're raising each year with a mandated requirement, and what if you put in more yourself? Like you said, any other goals that might need funding, changes to your asset allocation. So we've assumed that somebody selects an asset allocation and then keeps it that way forever in this scenario, but that's just not the reality for most people. It's probably not the best way of managing capital is to never change asset allocation. And even variation on returns or differing market conditions and the end effect on capital. So one of the big things that's really important is, how have you got confidence that, like we say, you retire and in the first year of retirement you get a GFC style event? Are you going back to work, or have you built a portfolio that's robust enough to keep you retired during that space of time and keep drawing income from it?
Absolutely. So I think with this section, Teneale, would you summarise it as
I think that
advice? Is advice been provided here, do you think?
I think that it was a lot of it was guidance to go out there and make some decisions based on a lot more research being needed into your existing portfolio, into your acquired portfolio, and then being able to drill that down to returns. So can most consumers do that? I mean, probably with enough time and resources, but one of the reasons that we do this podcast is that there's so much information, and it just leads me to think, if I was given this much information, would I feel confident that I had a financial plan? No.
And is it right?
Yeah,
Absolutely. So again, we're saying good starting point, but doesn't really give you the detail and the layers that you need to unpack it to be right for you.
That's
with
right.
confidence.
Exactly. But it didn't end there, right? That wasn't the only advice that it gave. So then it spoke a bit about what to do with super.
Absolutely. So the next one was, it came back as a recommendation that says boost your superannuation contributions. The first one was to salary sacrifice, and it said consider increasing your super contributions through salary sacrifice. This can reduce your taxable income and boost your super savings. So for those that don't know, we have mentioned it on a previous podcast, but effectively salary sacrifice is taking your money before you've been taxed on it at your marginal tax rate and putting it into your superannuation. When it goes in, it gets taxed at 15% in super, and you don't pay tax at your marginal tax rate. So it seems like a tax effective strategy. And the next one was a spouse contribution. It's recommending that they make spouse contributions. It says your wife can also make additional contributions to her super. So, I mean, we love a good superannuation contribution strategy, Teneale, and I think, when you see something like this, you're like, oh yeah, potentially it can be good, and superannuation is the most optimal tax environment to grow your wealth in Australia, and salary sacrifice, spouse contributions can be an excellent way to get your money in there and provide some tax effectiveness for you along the way. However, this answer, there's still a lot of things in there that are missing for me as part of the advice that's been given. So first of all, the very obvious, it doesn't actually say how much to contribute.
Which is interesting because we gave our salary now. So it knows how much we earn, but yet it hasn't actually used that information and overlaid it with current caps and understanding of employer SG rates and said you could contribute X, Y, and Z.
Yeah.
Now, understandably, it probably shouldn't say that, because what if I had already done some salary sacrifice? It doesn't know that,
well,
right?
This is the point, right? This is where it can be quite dangerous. It's probably tried to be quite broad and non-specific so that it doesn't cause issues for people, because it absolutely can. So when it's saying here salary sacrifice, you've got to think about, well, how much can I put into super and salary sacrifice, because there is contribution caps to consider, which is $30,000 this financial year that we're in at the moment. That's concessional contributions. So a bit of a summary, that's going to be your employer contributions that are made and your salary sacrifice.
Yeah.
All of that is limited to $30,000. So you've got to think about what's happening in that space first. And the second thing is there's been no cash flow test here. So can you actually afford to make salary sacrifice contributions?
No, they can't eat this week, but they can put the money to super, okay?
Good tax effective strategy, but that's not really going to work. So, perhaps they actually need their surplus income at the moment. It says that they've got young children, so they're obviously raising their children. What about other goals that they have? Because building superannuation might be important, but they might otherwise get to their retirement goals and the income that they need without doing the salary sacrifice. That's the big question mark. Do they actually need to be doing this?
Yeah.
Could they be using cash flow for something else, perhaps other goals that they have?
Yeah.
So, it doesn't really unpack that factor at all.
Absolutely.
A lot of missing information for me in that situation. And there's also a part of me that worries about this type of recommendation that's been presented, in that, if people take this up and then in 5 years' time they realise, oh, damn, I needed that money, or they put too much in And now all of a sudden, when they lodge their tax return, they've got a tax bill that's due because they went over that concessional contribution cap.
Yeah, of
is
course.
another thing to consider.
Of course. And then even who should salary sacrifice? Are you saying that I should, or my wife should, or both of us should, or and it's not going to have due consideration to interactions with things like age pension as well, because they've got different ages. So one person's going to become eligible for age pension first. Who should be building super at a higher rate?
We
therefore,
could get into all of the complexities of this one, because
this is why I was so excited about doing it, because my head just goes into overdrive thinking about all the possibilities. But
and then there is a hell of a lot that sits underneath this particular strategy that's been touched upon, and the way that it can impact an individual, and whether it's actually the right thing to do.
That's right.
It could work, but is it the right thing to do, like you're
That's
saying?
right.
You know, which person should do it?
And we're talking about one goal. This is what gets me. There's so much complexity. We're just talking about what we think is simplistic in one retirement goal now.
Yeah.
Now, we've spoken a bit about build your super. The AI also told us what type of returns we need to achieve on our super, but then it's going to be a little bit cautious, and it's given us another recommendation here and said investment strategy. You've got to make sure that you actually diversify your investment. So ensure, but it's still talking about super, ensure your superannuation is invested in a diversified portfolio to balance risk and return. Great. We spoke about risk and return before, so it's addressing the fact that that is a due consideration. And then review regularly. So regularly review and adjust your investment strategy. So just talking about what you are investing into now only based on market conditions and your risk tolerance.
Oh, there's so many things in that are just ringing alarm bells to me, and how that could be interpreted.
I know there are so many different ways, particularly, you know, we're talking about risk tolerance. We just mentioned that there's 3 different aspects that we look at when it comes to risk, and risk tolerance is one of those, not the be all and end all, right?
Well, what's a diversified portfolio? What do you consider as diversified?
I mean, for avid listeners of Wealth Experience here, they're sitting back going, I know you guys talk about the foundational principles of good investments, you know, long-term investments and diversification. And so we've heard it all, but you're right. You know, for the most part, people will consider 20 to 25 stocks in a portfolio might be diversified. And we've debunked that myth plenty of times, haven't we?
So. You know, or it could be undiversified, but it's in crypto, it's in all sorts of weird and wonderful things that carry high risk.
I've got bullion in my portfolio. No. But there's so many things that a holistic investment strategy needs to consider, you know, even just outside. So say we tick the box and we go, look, I've got my broad diversification in place, but I also need to consider cost. How does that interplay with risk and return, and return in particular in a portfolio? Like I said earlier, allocation to different asset sectors, the relevant asset allocation for you based on those 3 different areas of risk needed in the portfolio.
That risk triangle.
The risk triangle, yeah. Does your existing super fund offer what you need? So in no part of this has there been a suggestion to actually have a look under the hood in the existing investors' super funds and understand, is this the best alternative, or are there better alternatives out there, particularly when we think about things like costs as well. And, you know, all of these factors need to come together because we've spoken a little bit before about actively managed funds, passively managed funds, indexing, asset class investing, you know, different bands when it comes to how you're actually investing your assets. So all of that is really quite nitty-gritty detail when it comes to a really well diversified and structured portfolio, but it's not something that should be forgotten in this. We can't make it a very simplistic model, particularly if we want to have a high confidence of achieving that goal. So
because that's the engine piece of making everything happen, right? You've got all these other strategies that you can do around that, your super contributions and cash flow management, but if that engine isn't running smoothly, so to say, you know, have a diversified portfolio, like you were saying, you've really got to get into the crux of, well, what are the factors here that I've got to consider, and how do I bring all of that together?
That's right. And, you know, AI's then told us to review it regularly as well too. So for the investors, you know, the consumer that's sitting on this side of the computer going, I just did all this work to get it in place. Now what do you mean by review it regularly? How regularly should I be reviewing it? And are you telling me to keep changing my portfolio and adding emotion to it and getting that bar of soap, and every time I touch the bar it gets smaller, because that's typically what happens when it comes to investing and looking at your assets too often. So that's the risk that I see in that recommendation of regularly reviewing it.
Absolutely. And it is saying there, review it based on market conditions. As we know, if you are reviewing it based on market conditions, that's probably one of the biggest wealth destroying decisions that you can make.
That's
COVID,
right.
like you mentioned earlier, being the perfect example. Oh no, COVID, panic, sell to cash, and then you potentially missed out on a best year of returns that you could have otherwise had.
Exactly right. Exactly. So yeah, it's definitely getting the consumer here to focus, I would suggest, on the areas that we should have less focus on. We should be building a good investment strategy and then allowing it to do what it needs to, and only adjusting when the strategy calls for it, when the personal goals calls for it. Yeah.
I wonder if AI could actually build out a sound investment strategy if it asked more questions.
Well, we know. And one thing I would say for listeners here is that we are specifically talking about just using a chatbot to identify some strategy thinking if you were building your personal plan yourself. Now, there is such a thing in Australia as robo-advice, which does exactly what you're talking about, Cal. So you input all the information and a robot sits at the other end and generates you a financial plan. That's a whole topic for another day. And, there's certainly got its own points. But for this part, we're talking about AI-generated outputs, I should say, based on what the consumer's just putting into to publicly available AI.
Yeah.
Yeah.
So outside of that then, so in summary, we've got the investment recommendation. Again, pretty much the same theme that we're seeing here through all of the recommendation that it's given. It's very generic and it just doesn't dig deep enough to really give you something that's going to be a sleep at night strategy. Know that it's right for you. But there's still more. So the good thing is it's still coming with more tips for whoever input the data on getting some good financial advice. So the next one says, plan for other income sources. And it says age pension.
Oh, there it is.
Yes, it's there.
Yep.
But has it thought about how to maximise your age pension? So it says check your eligibility for age pension and how it can supplement your retirement income. So that part, I think that's really good, because it's starting to think about, well, you've said you need 80,000. If you're entitled to age pension, perhaps you don't need to draw 80,000 from a portfolio, and it's 60,000, because combined you're able to get age pension.
But I guess again it's going to be pretty simple, right? Because it told me I need 1.6 to 2 million, which is above any asset threshold, so we're out.
That's exactly right. But again, it hasn't really thought through any structuring or opportunity there to make that happen for maybe a short period of time.
Yeah.
So age pension for this individual may be well into the future, but again, it's not giving you a time frame of when it would be an expected reasonable time frame that you'd be eligible again. But it also says here, part-time work. Consider working part-time or consulting in retirement to supplement your income. So I guess this is quite confusing in that, are you saying if I do all these things I can afford to retire and do this, or are you saying actually I need age pension and I need to go back to part-time work? That part's probably not quite clear. And if you are returning back to part-time work, what does that then mean for your plan? Can you spend
How does
more?
it interplay with it?
Yeah. So it's quite generic, and I don't think it's too helpful, but like you were saying, there is no eligibility from point one if you've managed to save that retirement goal. So you'd have to check what that would look like and when you think it would be relevant to you. But that's a minefield of itself. You'd have to understand all of the rules around, what forms part of your assets for age pension, what income might form part of that. Because if you're going back to part-time work,
that's right.
And you're going to income, you might not be able to apply for age pension.
That's right. I mean, you can ask AI to give you all of that information, but if any of our consumers haven't read a DSS guide, go right ahead and do that. and we'll come back in a year's time once you've read the intricacies of the way that the government sector works in that space. So it is, in and of itself, that strategy would need a whole heap of unpacking and a whole heap of work around it, wouldn't it?
Absolutely, yeah. So again, in my view, very generic. Yes, it's things that you need to consider, and considering age pension earlier on in the strategy is always good. Maybe 10 years out, so you can have a bit of a plan around, can you do something more here or whatever that may be. We won't delve into the crux of that either, but Yeah, it's still not very specific to this individual.
Yeah. And I think for the most part, these last couple that it's talking to us about, which we'll just quickly go through the last few, but they're really kind of round out points in terms of a good financial plan should have X, Y, and Z in it. So I think they're good indicators is what I would say. They're definitely ones that go, hey, don't ignore looking at Centrelink provisions, and don't ignore those other income sources, but they're not the strategy. So the next one that it told us to do was to manage our debts and expenses. So go and pay off your debts, aim to pay off any outstanding debts before retirement. And then budgeting, create a detailed budget to manage your expenses and ensure you live within your means. And first of all, you mentioned previously, Kelsey, there's no clarity on if this couple do have debts or not, and what types of debts, perhaps, which is, that's important to know, because in this scenario, we're saying be debt-free by retirement, which, for argument's sake, for the vast majority of Australians, you would expect having debt paid out by retirement is a pretty good strategy. It's a pretty sound strategy, right? But if at the moment they've got some good debts and some bad debts, so maybe I've got a home loan that's non-deductible, but I've got an investment loan which is deductible, what's the payout plan on that? Which one, is there due regard to which one do I pay out first? What interest rate should I, which one should I be targeting? If interest rates are different, if security needs to be released at different points in time. So again, there needs to be a bit of a strategy of how you manage that debt pre-retirement, and make sure that you do have, a solid plan for your surplus cash flow, so that it can be gone by X years before retirement or X years into retirement. So, and as for budgeting, of course, this is a key foundation of any good money management strategy, and should ideally be something that everyone sits down and reviews. It didn't exactly give a recommendation for how to do that, though, did it, Kels?
No, it didn't.
No.
Right. And I don't think there was any tools that were provided.
No,
either.
no. Now, if it had directed you to Money Smart beforehand and you did go on to that, I'm sure you'd find that there's other budgeting tools on there. But again, it's how we link those things to a goal. So if I'm an end consumer and I wanted a good financial plan, budgeting for the sake of budgeting is going to be pretty boring, and it's not really going to feel like a very fun job unless I'm able to say, well, I'm saving myself $5,000 a year in expenses over here because I have the ability to put them to this goal and get me there quicker.
Want to invest your hard-earned money but don't know where to start? Alman Partners True Wealth presents AP Direct Invest, your online self-directed investment solution. Choose from 6 low-cost exchange-traded fund portfolios, including 2 socially responsible options. To manage your own investment experience, visit alman.com.au/AP Direct Invest and start your investment journey today. AP Direct Invest, your investment solution. Any financial product advice is general advice only and may not be appropriate for you. Always read the PDS.
So again, Teneale, very, very generic. It's not really giving us advice here. It's giving some pointers. If you have debts paid off, again, doesn't give the underlying details, not going into your personal situation. There is a next recommendation or suggestion here that says, seek professional advice.
Hang on. We just did this whole conversation based on not getting professional advice.
Right? So if all else fails and you still can't figure it out, go and find a financial advisor. And it says, consult with your financial advisor to tailor a plan specific to your needs and circumstances.
Well,
and
I take it all back. This is the best recommendation it's given.
Right. This one speaks for itself. And I think that it's a good way to kind of summarise. It said all of these things, but really it's got keywords in there. Tailored. A specific plan to meet your needs and your circumstances. So I think that, like I said, this one really speaks for itself, and no doubt there's lots coming through to the market in terms of AI bots that can help some more in this area. I
just think that a lot of the time what it comes down to is that people don't want to take the human out of advice, because if financial advice could be, done on roboticized, I don't even know what the word is for it, we're assuming that the person that's sitting behind the financial plan is not a human, and as humans we need the ability to relate, and when different market conditions happen, when life changes happen, and so I think that's the part of it that really a tailored financial plan needs a human in existence to help with.
And I think that's what some people probably don't realise about receiving financial advice is that you've got your own thoughts, feelings, your history of what you've experienced, templates, and it's really hard to get out of your own head sometimes.
Yeah.
And just having that third party that can help you navigate and walk through that and be a sounding board.
And I think we've spoken
can
about
really change
that's
the
right.
outcomes and the goals and the way that you think about your financial plan.
That's right. And I think we've spoken about before too, Kels, that sometimes a good strategy is not a good financial strategy. It's just a good strategy for the client.
Absolutely.
Because sometimes the way that you're wired, just, some people don't save money if they've got a savings account, but they save money if they're given a credit card to put their expenses on, whereas that might not be the best sound advice for everybody.
Absolutely. So it's behavioural. You've got to know we have an obligation to know our client, and there's absolutely reasons for that. And I think at the moment I've failed to see how AI can do that sufficiently enough, because sometimes it's in those little things that might be unsaid, right? Body language.
Oh, yes.
All of those sorts of things. Can it really be smart enough to pick things up that otherwise wouldn't be picked up if he wasn't in front of it? I don't know. I just don't see how it could, but I'll probably be proved wrong in 10 years' time. I hope not.
No, I think we'll be working alongside AI. Let's put it that way.
I do think so. I think AI can certainly be used to make things quicker and more efficient, and definitely be weaved into the process. Yeah. And saving time. And if you save time, you can save money, and that helps everybody, right?
Yeah. So it's letting AI pick up the pieces of the puzzle that it can, and then leaning on the human where you need that support that emotional support as well along the way. So last piece of advice that it gave us was regularly review your plan. So much like reviewing your investment strategy, then it said adjust as needed. Life circumstances and financial markets change, so regularly review and adjust your plan. Now, this is imperative. We know that once the plan's put in place, we can't just leave it like that. Things do change. Advice is not a set and forget strategy because life happens. And we did touch on this a little bit earlier when it came to the investment space, so it's very similar. I probably won't go into too much more detail here. But it did kind of have me thinking when I looked at this area. There are some other factors that need consideration when you're seeking to get support from AI in the financial advice area. Data security concerns probably comes to mind. So if I'm a consumer and I'm sitting there, I'm inputting all of my information, how much information am I actually comfortable sharing with an unknown source of where that's going? I probably don't want to be anything more than relatively simplistic, because I want my data security to be utmost importance, right? Yeah, absolutely. But there's a problem in that. If you're if you're not providing all the information because you're concerned about security, you're going to be getting the best outcomes. Yeah. And like you're saying, how do you know where that information goes and who it's shared with? Exactly. So definitely a big concern. Another one for me, Teneale, was whether AI can actually act as a fiduciary and whether it can engage in ethical behaviour, because whatever it's, and I am by no means a tech wizard. I don't really know how it works, but I'm assuming when AI is built, it could potentially be built on a bias of the person that's building it, or however it's programmed, or however it learns, it might actually learn its own biases. So, well, it takes all known information that's available out there, right, and consumes that in a way. But as we know with AI, it has the ability to hallucinate, right, because it has all this information that's available out there, and it's its only source of truth. But if it's trying to create something that's new, it can hallucinate and go, well, this is the data that's really available to me, and that's all that's available to me in order to be able to come up with an answer for you, right? Yeah. So I think your thinking is kind of, I understand that in terms of the ethical dilemma that it may have, because what's ethically right is a grey space, and can never be black and white. So if the answers
Particularly if you're not having a conversation with someone.
That's right. So you're making an assumption based on the black and white data that I've got available to me here, but that might not be an ethical decision or an ethical suggestion, I should say.
Yeah. I think that's probably where it could come quite unstuck, and there'd probably have to be really specific circumstances. But yeah, I'd be interested if anybody knows more about that. I think that's quite an interesting space, because I don't think we're going to be able to get away from AI.
No,
it is going to become woven in some way, shape or form. So how does that part get managed? But yeah, good conversations today, I think, and there's probably a whole lot more we could have gone into. And if anybody's got more questions in this space or has information to share with us, then definitely get in touch.
That's right. And one thing I would say, Kels, as well too, is just, you know, if you can give us some feedback, listeners, we'd be really interested in it. But I'd also love to know, has somebody gone to the extra detail and then built their own financial plan using AI and gone deeper and deeper and deeper and deeper into it? And how has that positioned you? Because like we say, there was some really good information that could start pointing you in the right areas. And if you followed those information trails and did your own research, you could come up with a brilliant financial plan, in all reality's sake. But how long did that take you? What was the outcome? Please let us know. Really interested to know that.
Well, thank you all for today, and we'll see you next time on the Wealth Experience podcast with your hosts Teneale, 𝐼𝐶𝐸 and Kelsey Dent, bringing you conversations to help you navigate living a healthy, wealthy life your way.
The opinions of the presenters are objectively ascertainable and are not intended to be financial product or personal advice.